Understanding loan production offices, LPOs. In the banking and financial services industry, a loan production office, LPO, serves a vital function. As defined by the Federal Reserve, an LPO is essentially an administrative division dedicated to loan-related activities, distinct from traditional bank branches. It is essential to understand the role, operations, and regulatory framework governing LPOs to better appreciate how they serve both the banking system and consumers. What is a loan production office? A loan production office is designed to handle various loan requests, primarily focused on residential mortgages. However, LPOs may also deal with other types of loans such as personal loans, small business loans, and commercial loans. The key characteristic of an LPO is that it cannot directly issue loans but plays a critical role in the processing and administrative support related to loan applications. Key functions of an LPO. 1. Loan application processing. LPOs play a crucial role in the review of loan applications. They are responsible for collecting documentation and checking whether the application meets underwriting standards. 2. Client communication. LPO personnel, including processors and underwriters, interact directly with loan applicants to gather the required information and answer any questions. 3. Analysis and recommendations. LPOs analyze applications and may provide recommendations regarding loan approvals based on their findings. However, they ultimately forward applications to the central bank office or a designated branch for the final decision. 4. Educational resources. LPOs provide clients with educational materials on mortgages and loans, which may include proprietary content from their parent bank or general resources from government agencies. Staff roles within an LPO. Several key positions function within a loan production office. LPO processor, responsible for the collection, distribution, and analysis of information necessary for processing loans. Underwriter, assesses the risk associated with the loan application to decide its viability. Loan production leader, oversees operations within the LPO. Loan specialist, concentrates on specific types of loans and client needs. Customer service coordinator, handles inquiries and provides customer support throughout the loan process. Limitations and regulatory considerations. Because LPOs are not full-fledged branches of banks, they operate under distinct regulations. For example, LPOs are not required to display certain regulatory signage, such as FDIC notifications or policies regarding availability of funds and collection of checks, Regulation CC. However, they must display an equal housing lender poster. An LPO cannot negotiate loan terms or rates. This responsibility lies solely with the bank's main office. To gain the ability to provide full loan servicing, an LPO must petition the state banking commissioner for permission. The process flow of a loan production office. Here's a step-by-step breakdown of how an LPO generally operates from loan application to disbursement. 1. Application submission. Clients submit loan applications to the LPO. 2. Data collection. LPO processors collect necessary documentation from clients. 3. Completeness check. The LPO verifies that the application is complete and checks for adherence to underwriting standards. 4. Recommendation. The LPO may conduct an initial analysis and recommend approval of the application. 5. Forwarding. The application is forwarded to the main bank office for final consideration. 6. Funding. If approved, the LPO may coordinate the disbursement of loan funds. LPOs versus loan servicers. It is crucial to distinguish between loan production offices and loan servicers. Loan production office, LPO, deals primarily with the loan application process up to the dispersal of funds. They handle the administrative aspects of loans but do not manage the loan after the funds are provided. Loan servicer takes over once the loan has been disbursed. They manage repayment, customer service, and, if necessary, foreclosure procedures. Loan servicing has evolved significantly, with many loans being managed by third-party entities. This shift allows banks to focus on their core lending activities while specialized firms handle the complexities of post-loan management. Conclusion: loan production offices play a crucial yet often underappreciated role in the lending process. By streamlining loan applications and providing vital support services, LPOs enhance the customer experience while ensuring that the lending institution adheres to regulatory requirements. Understanding how they function can empower consumers to navigate the loan process more effectively. Whether you are seeking a mortgage or personal loan, awareness of the roles played by LPOs and their limitations can help you make more informed decisions.